What's up, everybody? Michael Silva here. Long time no see. I'm out here on vacation, hanging out with the nephews there in Maui. You're watching the Stock Market Brief Show. Today's episode is titled, Just Do the Opposite. What do I mean? Well, we're going to talk about that in today's episode, which we're going to get right into. First and foremost, GDP. 2 negative quarters. Every time we've had 2 negative quarters, we've had a recession, despite what the media is trying to tell you that they don't see one. Yellen says the economy is not in a recession despite the GDP slump. Okay, and I get it because a lot of people are going to believe this because the market goes up. Stocks are going up. Take a look at Apple reporting after hours. Hit its upper expected move for earnings. Big boom right there. But even bigger was Amazon reporting, and that was a huge move to the upside, breaking significantly past its earnings expected move. But let's not forget about the companies that aren't doing too hot. Look at Intel reporting after hours, getting completely smashed. Roku completely smashed as well. All right, so despite all this stuff, if you just pay attention and look at things behind the curtain, which we will talk about in today's episode, you will notice that it's not all, rainbows and butterflies right now. There's actually a lot of things breaking down that we need to be well aware of, okay? So it's very difficult to just make these short-term decisions, to catch the move or chase the move or FOMO into it. Trust me, there will be plenty of opportunities. If this is the bottom of the market, you will be granted much more opportunities to catch the move to the all-time highs, guaranteed, okay? But if you are FOMOing into this and we do see this as a bear market rally, well, guess what? You can get obliterated in that. So you got to be very careful. You got to be tactical. Position sizing and risk management is key. We're looking at the 10-year yield right here, looking at the curve specifically, the 10 and 2, and the 10-year and 3-month Fed staple. This continues to fall off a cliff. I would not be shocked to see this invert here soon enough. It's at 0.26, so 26 basis points, and negative 17 basis points for the 10-year and 2-year. This just remains completely inverted now for significantly past 10 days. If you take a look at the 10-year yield, it is potentially forming a head and shoulders topping type pattern. Now, you tell me, is this good for banks when the 10-year yield crashes down? No. And if we've, I don't have the chart with me now, but you can see that even the relative strength line between XLE, okay, XLE versus SPY, if you pull that chart up and measure it to the 10-year yield, they move hand in hand for the most part. So if this does start cracking down, energy might be getting hit too, which also means that oil could be potentially starting to head lower and various other commodities. If you take a look at the TLT, a lot of people have been wondering, when should we get this, right? Well, TLT is forming somewhat of the opposite, right? Well, go figure. Inverse head and shoulder. So this could be basing out where we can see potential breakup of 120 and see all of a sudden if the fear trade, instead of maybe going to dollars, if the dollar wants to break down, perhaps the fear trade goes into bonds. But we will continue to monitor that. On a good note, the Saylor to Schiff tool continues to be on a buy signal heading pretty much north, which is nice. So we'll pay attention to see if this starts slowing down here momentarily, right? So we got that buy signal right here. Boom, broke through that week, and now we're starting to see a nice little pop there. But that's just with Bitcoin chart. If you take a look at Ethereum, if you took a look at crypto equities, all great. So when this starts turning back down or goes through zero, we got to be well aware of when that takes place, okay? Now, this was a chart that HedgeEye put together and they shared on Twitter. I like this because it shows you how do the past crashes compare to our current crash. And this is why I say kind of, hey, just do the opposite, right? Everyone right now is trying to call the bottom. There's many people doing very, very bullish narratives, and rightfully so, right? People want to be bullish. You want the market to go up. It's a lot easier to go long the market than it is to tactically play short and long. All right, but you can see here the blue line is where we are now. The orange line was 2007 to 2009, and then the black line is from 2000 to 2003. So we're looking at the dot-com busts, process of that, and then also the financial crisis. And you can see we have had, plus 8% rally, plus 12%, plus 7%, plus 18%, plus 23%, and those weren't the bottom. But people were definitely for certain saying that the bottom was in multiple times that we saw these. And we're seeing very similar stuff, plus 11%, plus 7%, we're plus 10%. Okay, if you take a look even further back to the dot-com bust, you saw 19% rally, 21% rallies, 21%, 20% rallies, and they all got just completely hit. So understand that bear markets, they have rip your face off rallies, which we've talked about ad nauseum. All right. Now, Powell signals. This is all taking place. Understand this. It is taking place while Powell is tightening into a slowdown. We have clearly an economic slowdown taking place, not only with GDP that we're noticing, but also with these earnings seasons. We're starting to see a lot of earnings compress, and we are still tightening into that. So understand that there is still risk here despite the market going up for a couple of days. The Fed, I mean, maybe perhaps the reason why people are getting excited is because now we're pricing in, hey, the 75 basis point rate hikes are over. We're now looking at around 50 basis points. But understand that is still raising pretty aggressively for the most part into a slowdown. Okay, so and it doesn't take 75 basis point record hikes that haven't seen in a long time to have something crack. It could crack at any time. So we got to be aware that hey, they are still on a path currently to tighten. Okay. Now let's look at some bigger time frame charts and then narrow it down a little bit. This is something that I shared on the monthly recap. I wanted to point out that the S&P 500 is right about the monthly expected move. Okay, we're outside of the bear market territory as of now, but understand we are just trying to reconnect with the monthly 5-EMA. We're still below it at this particular point in time, so we'll see if we can get above it. The quarterly expected move is that dashed line slightly there above it as well. So as it stands right now, all we're doing is getting a technical bounce into a declining 5-period monthly EMA. If you take a look at the Qs have not tagged it, but we are outside of that monthly expected move, and we're not too far off the quarterly expected move. So if we get a little bit press higher, around 320, that would be the quarterly expected move. We'd be hitting it very early on, and we'll see what takes place. But we still haven't even reconnected with the monthly 5-EMA. And understand, too, if you're looking at the PPO down here beneath us, that is still wind at our face at this particular point in time. The one that is getting close by a few cents here is the IWM. It has reconnected with the monthly 5-EMA. I mean, if we're being very technical, the high for IWM was 186.14. The EMA is at 186.33. So technically, we've missed it. We'll probably hit it at some point, I would imagine. And we are above the monthly expected move, too. Not too far off from the quarterly expected move. And yet, both the IWM and the NASDAQ are both in bear market territory currently at this time. You can see under the red shaded area, and volatility is still elevated as well in both those index products. If we take a look at the weekly expected move, SPY is pressing outside of the weekly expected move. Last week, we got outside of the weekly expected move. We discussed it, and guess what? 2 straight days pretty much downwards, or 3 down days, and we reconnected with that weekly expected move. So we'll see if we get something similar. As I've stated previously, we've had a bear market rally right here into a prior area of resistance, and it got rejected. Maybe perhaps we come up to test this or get up a little bit above it. Maybe that brings us to around 415 to 420, perhaps, and we'll see if we get some sort of reconnect. Given the case that Amazon is reporting and Apple, and it looks like it's going to be gapping up, there's a strong possibility that that helps perpetuate the SPY higher as well as the Qs, which the Qs are not too far off its weekly expected move. Probably going to be hitting that tomorrow if everything opens up with that gap up. So we'll see how that works. But overall, understand that in the short term we have higher highs, higher lows. It's trending in this little channel right here. Could be considered a bear flag. We got to see if we can get above this 310, 315 level and actually hold it. That is the important part. If you get above it like we did right over here, we didn't hold it, and then it got smashed. Even if we give above here, understand still lower highs, lower lows, and we're below a declining 200-day moving average. So it still remains to be a very tactical situation. IWM, very same situation. Outside of that weekly expected move, not too far off from that 190. We'll see here if it breaks through this channel, the upper trend line of it, but it's just higher lows, higher highs right here in this channel. So continue to watch this channel and see how price fits within it. If we zoom in a little bit closer on the 15-minute time frames, we are slightly in that overextended territory with a negative divergence as we're outside of that weekly expected move. So if we gap open tomorrow, perhaps if we start selling into that, that could be an exhaustion gap signaling some sort of a top. So we'll see how action plays out given Amazon and Apple's potential gap up from what it seems like. Okay, if we take a look at the Qs, probably going to be hitting that weekly expected move. I would imagine so. We're not too far off of it, just like we weren't too far off of it for SPY. We tagged that. We do have a negative divergence building, and we're above the 5-day moving average, which is inclining here. So short-term perspective here still remains to be bullish, but just understand where prices came from. We need to see some sort of digestion to have better entries or pullbacks, right? If we take a look at the IWM, is getting outside of that, like we stated, negative divergence, inclining 5-period moving average. Okay, so bullish context, but understand where prices came from and how fast it got there. So we need to see some sort of digestion, pullback, something take place in order to feel more confident going long or making a long entry. Now, this is why I say kind of just pause, just do the opposite. S&P 500 BP charts at 75.46. I can go back multiple times when we got to these levels, and what you notice shortly thereafter is the S&P 500 either pulled back, digested through consolidation. So be careful here, right? Not really the place where you want to buy it, just like the place where you don't want to short it, where everyone talks about down here. They're like, oh man, should we just get short? No, you shouldn't get short when it's already overextended to the downside. Just like you should probably be taking profits or start looking for digestion when it's up to the upside, okay? BP, CO, and PQ, so the NASDAQ composite, it's at 73.20. So yeah, it's getting overextended. It's clearly moving into that territory. Overbought can stay overbought for a while, so always remember that right here. Okay, so that is always the case, but understand where prices come from is very important. We haven't seen some sort of really like solid digestion yet. If you take a look at BPINDU, it's moving to oversold territory, overbought territory. The bullish percent index for technology sector, you can see 74.15, getting a pretty overextended reading here. We've seen that before too at these bear market peaks. So pay attention to that. Energy, 74.05, overextended territory. Financials now is moving into that overextended territory, 69.75, not quite 70. And we got a reading today. The SPIP over GOVT, the rate of change clicked through that 1.3%. We moved to 1.74. Every time that this has happened in the last, 10 red lines that you can see across the screen, I don't have them all up, but 1, 2, 3, 4, 5, 6, 7, and then there's a couple more behind us. 10 for 10, it gave us a heads up notice that volatility was right around the corner. We don't know how high volatility could potentially spike, but it has given us a heads up notice. So it's given us a heads up. Let's see if it plays out this time. As of now, I would imagine that it's given us a heads up just based off of the historic movements. When it gets down to the low end, that gives us an idea that volatility may subside, and that's also played out. We talked about it right here. Volatility's been subsiding. Now we're back up here. We'll see what happens. Okay, so keep that in your mind. And then this, I want to follow up on this chart. This is looking at growth versus value, and I want to call out, even though that we're seeing the move higher, and we may continue that tomorrow given the earnings, look at the rate of change. It's still putting in lower highs. We haven't crossed down through 0 yet. We're at 1%. We were lower. We're at like 0.3%, and then it bounced up a little bit, but we still have a divergence playing here as price is moving up. Price action of the relative strength line is moving into this prior era. So we'll see if we can break through this downtrend right here and go up higher, or break through this, or see if it's going to start breaking down through the 0 line. If it breaks down through the 0 line, I would imagine that's going to put pressure on the Qs. Let's close today's episode out by just saying, kind of overall thought process. When I say just do the opposite, when it gets to bullish extremes, many people want to chase or ignore what they want to do what their emotional self is telling them, okay? You typically at these times need to either one, step away, or if you're really tactical, understand how to fade your emotions. If you know how to do that tactically, you can be very, very successful, especially in these bear markets. But take a look here. This is the zones that we're looking at. I'm not going to get into too much detail of this, what these are, how they're calculated, but for 7/29, which is tomorrow, just understand that, hey, this S&P 500, we're talking 1% upside to 6.82% downside. These are dynamic. They're always moving, but it gives us an idea if you look across the board through the other sectors and everything. Screenshot if you'd like. Bam, there you go. It gives us a good idea of like, hey, is downside growing while upside's kind of trugging along? And the thing is right now we're talking, risk is 6 to 1 potential upside, okay, right? 1% to the upside, 6.82% possible downside. So yeah, it's a little, it's a little skewed right there, telling us, hey, there's a lot of risk growing to the downside. The VIX, 20% upside to 5% downside when we just had that signal too. Something to pay attention to is SPY, obviously the same as the S&P 500 for the most part. IWM, 1.84% upside to almost 9% downside. So the downside portions are once again growing. We talked about this a few days before this little squeeze took place, and we started to see the market pull back and adjust some stuff that took place, okay? So as I see it right now, the downside risk is still continuing to grow, which means the range is expanding to the downside, but also moving up higher as we're going through a very important week with all these economic data drops and so forth and earnings, okay? The market has to digest all this information. We just threw a load at it. So let the market digest. Be calm, be patient, be tactical in this environment. Because if you try to just say, oh, no, I'm just going to get in right now and chase things around, it could get bad and it could get bad fast, okay? So be careful. That's all I got for you on today's episode, everybody. I'll be back in my studio office probably within the next couple of days here. So I'm looking forward to that. See you guys all later. Bye.